Mr. Dan Bird, you've been telling me for quite a while that you expected a year-end rally, and while I was out in Germany on a river cruise, it certainly feels like one has started. What's going on in the market?
So you remember that,
I, you only have to tell me 100 times before it sticks in my head.
huh?
Yes, I remember.
All the way back at the beginning of the year, I think it was.
Yeah, you have receipts, as I like to say, because you
Yeah,
have all your videos in your playlist.
that's not a recent comment.
No, you're right.
And by the way, it's not a prediction. I don't do predictions. It's all about risk management,
Yep.
not about predicting. And welcome back from your river cruise, by the way. We
Thank
did
you.
that same
Yeah.
cruise, exact same cruise, but we did it the opposite way
Yeah.
from
It was a lot of
Amsterdam
fun.
to Budapest, and it was pretty cool. And by the way, I saw your video about comparing ocean and river. One thing you left out in that, and I'm not sure if this is a plus or a minus,
Okay.
but river cruises don't have art auctions.
Yes, they don't have art auctions. They don't have the casino. Yeah,
So theoretically, it actually could be cheaper.
probably. Believe me, I bought some. Yeah, exactly. So that's pretty funny. So why don't you tell us what's going on in the market? Because Friday was really all week, all month. I think November was like up 10% or something. It's a pretty good month. Kathy Wood had a 30% month.
Yeah, well, I mean, everyone in the growth space should have a good time. And I said back in October, I think it was the very last week of October, I said Wednesday is the worst day of the year. And that, the rest of this week is the worst week.
I remember.
And right on cue, the Monday right after that is when the market took off.
Very cool. So show us.
So it's and I've pretty much been saying that most of the year. And I said hitting back to all-time highs. We're not back to all-time highs yet.
Correct.
But it potentially could get there. I'm actually a little surprised at how strong it's been. Let me share, and we'll talk about the market in the first one. In the second one, we'll talk about all the economic indicators I like to look at, and that will include inflation. It will include the Case-Shiller index. It will include rates. We'll talk about rates,
jobs,
whether they're going to crash,
unemployment,
jobs, which is next week, and all that.
Yeah. Okay.
So let me share now. We'll just take a look at where the market is and where it's been. For those that are interested, you can reach me or get my free newsletter at breakpointtrading.net. And the free newsletter is right here in the upper right. I just changed this a little bit more. So now it not only takes you to the page for the newsletter, it takes you right to the newsletter.
Okay.
So you just click on that and you'll get the newsletter, which I put out every week, usually by 1 o'clock on Saturday afternoon.
Nice.
And on this main homepage, which is accessible by anybody, you don't need a subscription for this main page. I've got 5 charts right here in this little box. I actually had some people tell me, I didn't know. My brother said this. He said, I didn't know that there were charts there.
That's funny.
Yeah, there are. So you click on S&P. There's the S&P. So you see this dash line at the top? That is the high from March of 2022.
Okay.
Okay. Yep. So year and a half or a little bit more than a year and a half ago, that was the high. What you'll notice with the S&P is that we have now gone above this resistance line, which is the high for the year so far. This was in July. So we are at 52-week highs, closing highs as of Friday. And we're in spitting distance of the March high.
Right.
And then the all-time high is at a little higher than that. That's 46.19 or something. And all-time high is 48. All-time closing high is 48 something, 4,800 roughly. Okay. So we're pretty close. I mean, what, 5% away maybe?
Yeah, roughly.
Not bad.
No.
So that's the S&P. It just continues going higher. And one of the things that I mentioned on this video while you were gone was that I was kind of expecting a pullback. The market just went sideways right here, which is Thanksgiving week. So there's not much volume anyway, Thanksgiving week. And I said after the big traders come back, that's when volatility will come back in. It may either push it up or push it down. It looks like it's pushing it up. So I actually thought it would come down to the 21-day, which is right now, the 21-day is at 44 something, 44.85 roughly.
Okay.
But it didn't. Kept going up. And it looks like it might continue to keep going up.
Okay.
However, one of the things I said in the newsletter this week is if you compare that to the Nasdaq, which also is near highs, but it did not break this resistance line. So the Nasdaq did not break out like the S&P did. That actually concerned me a little bit. And I'll show you something else that concerned me here in a second as well. But still, it had a good day Friday.
Yeah.
So, and with nice volume too, down here. So that still looks good. The Dow is actually was the strongest one. Look at the Dow.
Oh, wow. Jeez.
The last 2 days, last week.
I had no idea.
Not only did it break out of that previous 52-week high, but it's heading straight up for that 38.8 level, which Stock Traders Almanac predicted back in 2011, I think it was, that the Dow would hit 38.8. Right now it's at 36.2.
Okay.
So it could very easily hit that next year sometime. And actually, they put a time frame on it. They said it would hit 38.8 by 2025.
Oh, there you go. Okay.
So it may hit there next year. May hit there by January. The way it's going.
Yeah, maybe.
Yeah, and Bitcoin, of course, continues higher as well.
Yeah, knocking on the door of 40 grand.
Yep, 40 grand. Went above this key resistance level right here with vigor. And the next Fibonacci extension is at 41,300.
Okay.
And you can barely see it right there, but that's the next level that if it can break out of this channel right here, or it just stay in the channel all the way up to 41.3. But
yeah, it still has some catalysts. I mean, the biggest catalyst, in my opinion, not a Bitcoiner. So if you are, then you can tell me I'm wrong. But this ETF that's going to be coming, one to multiple ETFs, and that that's going to be demand, and it's also going to be options for really rich folks that want to move 1 or 2% of their net worth to have some insurance. So I think that's net positive. It's a catalyst, I think.
Yes, depends on how that ETF is set up. If it's set up just to parallel Bitcoin, in other words, they buy Bitcoin and they just put it in the ETF. Sometimes they are kind of a separate entity,
right?
That mirrors the underlying.
Yeah, like Grayscale or something.
Like Grayscale, right? So it won't cost as much,
right?
But it won't exactly follow it, but it will mirror it pretty closely.
Yeah, I guess my point was there are some rich people, wealthy people that don't look at Bitcoin because they're not going to go on Coinbase and they're not going to get a wallet. They're not going to do all these things. But right. If you create an ETF and they could buy it in their Schwab account.
Yep. Makes it easier. And especially if the price is lower and if they come out with leveraged ETFs. Could you imagine? I'm sure. Could you imagine a triple leveraged Bitcoin ETF?
Oh my goodness. I can imagine. Yes, I absolutely can. Triple up, triple down. Yes, I can imagine.
So yeah, that could be coming. And if you look at the momentum indicators, they still have room to run as well. It's just crossing over to the upside.
Nice. Okay.
So that will be interesting. And then the fifth one here is the dollar.
Yeah, look at that rollover. Woo!
Yep. Not only the dollar rolling over, it had a little bit of a bounce Thursday, but then Friday it actually gave some of that back.
Yeah.
But look at gold down here. Gold is just really taken off. Yeah,
gold broke above 2,000. I think 2,100 maybe, something like that.
Yeah, right. And that 2,100 is a key level for gold. If it breaks above it and stays there, I could go much higher than that.
Well, we'll talk about this in the second episode, but yeah, look at that 10-year rate.
Yeah. Falling. I put them together with the 20-year bond. So you can see what happens when the rates come down, what happens to bonds. I've been saying that next year is probably going to be really good for bonds.
I agree, right? Because again, as rates go down, price goes up. So if you had bonds before, you're going to get not only yield, but you're going to get a return on the bond itself.
Right. Yep. And we'll look at a closer view of that in the next episode.
Nice.
So let's go back here. The first thing I want to do is go back to the portfolios, because just before you left, I think we talked about when I went to the money show.
Yeah, I remember that.
Saw Turner, and I actually talked to this guy. I talked to the CEO, Mike Turner. Yeah. And I did a trial buy. I actually want to add to this, but I'd like for it to pull back before I add.
Now, just so I'm clear, when you say trial buy, is this real money or is
this is real? This up here is real money.
Right.
This section here at the top is real money. So I'm going to use 100,000. I've got about half invested right now.
Okay.
Just to see how it goes. But what I'd like to do is I'd like to get both of these positions to something that is divisible by 100. I'm not sure exactly what, 200, 300, somewhere around there, 400, somewhere in that range. I'd like to add to these so that they have, in the hundreds, so that I can do covered calls against them.
Got it. Okay.
Which I think is going to be a really good strategy. But the important thing about this strategy, and I'm showing this to lead up to going back and talking about the markets and what they look like and where they might be headed, just to set the foundation for that. So this strategy basically looks at the whole market. The total index is 3,800 stocks. It incorporates the Dow, the Nasdaq, the S&P, and the Russell, and more. And then it looks at this on a weekly basis. So this is the total market right here, long-term weekly. And what I did was I created this chart that has no price on it, just to make it clean. There's no price on here. It's just moving averages. So when they cross, that's the buy and sell signal.
Right.
And you can see how few of those there are, going all the way back to 2020, 3 years. There was, 1, 2, 3, 4, 5 signals, 5 trades in 3 years. Yep. But because they're leveraged ETFs, you can make a lot more money if you can stay in through this period. And this helps you identify how to stay in. Now, what I did down here, and this is something new that I don't think I showed last time, but the green one down here is I basically mimic or reverse engineer Turner's chart.
Right. And
when I talked to him, I showed him this and he goes, yep, that's pretty close. That's pretty much what we're doing. Well, I added something to it. I added the bottom one is a MACD, moving average, convergence, divergence. The way the MACD works is it looks at the moving averages, and when they move away from each other, that means it's a much stronger trend. When that's diverge. When they move closer to each other, that means the trend is ending, or maybe ending. It's slowing down, at least. That is converge. So moving average, convergence, divergence.
Okay.
So the green one is theirs. The gray one is the one I added, which is a little quicker. It's a quicker view. So interestingly, right where these arrows are, which is where the 21-day crosses the 50 up here, just also happens to be where my converged moving averages cross, where the gray crosses the green. And now it's a little more choppy through here, but it's just a way to confirm what's happening up here.
Okay.
All right. So you never should use just one indicator, use multiple indicators.
I like it.
So that's that was the total market index. And if I look at QLD on a weekly chart, so there's what it looks like on a weekly chart. Right here is November 14th, where that arrow is.
Yep.
That's the date that I got in. Okay. Now you can see what happened. QLD, remember, is a double leveraged ETF. So it does double what the Qs do, double what the Nasdaq does. So in this period right here, which was almost a year, it's 188%. And then if you did the double leveraged negative ETF, you'd make a little bit, or you could just go to cash and wait for this green signal. And then through this period, going to cash would have been 39%. And as I just showed you, in 2 weeks, it's been up 4%.
Okay.
So far, it looks very promising. It's a way to keep your money invested for the long term, but still take it out when the market looks like it's really going to head down. So there's the real results with real money right now. That's a 2-week period of 4%. But notice the difference between the Q or the Nasdaq. Remember, I showed you this before with the Nasdaq and the S&P. Notice the difference in gains between the Nasdaq and the S&P.
Okay.
The S&P right now is outperforming the Nasdaq. So that's something that was kind of an unintended benefit of this. I didn't really expect to view it that way, but it's actually showing me very quickly that something's happening between these two.
Okay.
So if I go back into charts and look at a relative chart of the Qs versus the S&P, which is right here, the chart section, Q versus the S&P, now we can see right here. So the pink line is the triple Qs or the Nasdaq. And you can see the last 2 weeks it's kind of gone sideways. But the green line is the relative comparison between the Nasdaq and the S&P. Meaning, if this line is going up, then the Nasdaq is outperforming. If this line is going down, like it was all through 2022, then the S&P is outperforming. Or the Nasdaq is underperforming, put it that way. But look what's happening right now. As the Nasdaq has gone sideways, the relative strength versus the S&P has declined. And that's what that portfolio that I just showed you was kind of telling me too. Right? So when I come back and look at it in this view, this just confirms it. Now, the one on the top is the triple Qs. That's a weighted ETF. And you can see the weightings here: Apple, Microsoft, Amazon. The top 5 make up a big portion of it. And the S&P weightings have the same stocks, but not quite weighted as heavily. The one down here is equal weighted. So it treats all of them exactly the same. All right. And it's the same view.
Yeah, essentially.
The Qs are going sideways, but the equal weighted, the S&P is outperforming.
Okay.
Or the Nasdaq is underperforming. This is going down. That means the first one is underperforming. All right. So I thought that was really interesting. So what does that mean?
Right.
Does that mean that the market is setting up to crash? Well, that's where all the Magnificent Seven stocks are, right?
Yep.
But let's look at the sectors and let's see what the sectors are doing. So this is the sectors on Friday. And the S&P is down here. So everything above the S&P is outperforming. Everything below it is underperforming. On just Friday, you can see the only aggressive sector is consumer discretionary, which is where Tesla is.
Right.
And Amazon.
Okay.
The other ones, while, real estate and utilities for sure is a lagging sector. And real estate can be as well. But the other ones, industrial and materials, they can go either way. They can do well either in an up market or a down market. And financials typically perform well in the last quarter. In the fourth quarter.
What I see in that chart is essentially those are all the interest rate sensitive sectors.
That's true. That's a good point. Yes. Yeah. These are all interest rate sensitive and they outperformed on Friday.
Makes sense.
Now, look at the very bottom, the Nasdaq, technology, communication services, which is the internet stocks. They were at the bottom of the list on Friday. So let's pull back a little bit and look at 1 week. And now we've got utilities and real estate are also up there, as well as the other 3. In fact, they're all the same for the week.
Yep. Okay.
Communication services is the only one that underperformed. I mean, it was negative, I should say. Everything below the S&P underperformed the S&P. So if you want to beat the S&P, you need to be in things that are beating the S&P.
Right.
Right. But this kind of is helping to determine what the trend is, what's really happening in the market. Let's go back a month and see what happened there. So the S&P is way down here. Now you've got the Nasdaq outperforming, and you've got all the same ones, except for technology now is outperforming over the last month. So technology is starting to underperform, move down. However, what I am also seeing here is that if the market really was getting ready to go down, ready to crash, you should be seeing all of the defensive sectors, the 3 defensive sectors, which is utilities, healthcare, and staples.
Right.
Now, staples is underperforming down here. Healthcare is underperforming. The only defensive one that's actually even utilities is underperforming over the last month.
Right.
But over the last week, utilities is the only one outperforming. Staples and healthcare are still underperforming. Okay. But what this is telling me is that the market is broadening out. People are buying more than just the Magnificent Seven. So
and that was something we talked about 3 or 4 months ago. What would happen? Would they broaden out or not? And that's right. An interesting aha.
Right. I mean, that's what I see here, because normally, like we saw on the last, December of 2021, when the market was hitting all-time highs, but all of these the sectors here were all defensive sectors.
Right.
Even as the market was hitting new highs.
I remember.
And there weren't any materials or industrial sectors up here. So that was the warning sign that the market was ready to roll over. Right now, I don't really see that. I just see a broader market at this point. So I think that's actually a good thing. And one thing that I did was I took those charts without prices and I included them up here in the indexes. So now we can look at all the indexes that way. Long-term chart. So you can kind of lightly see the price in the background. And this is a daily chart. So this is a pretty good sense of what the trend is. And right now for the S&P, the trend is definitely up. In fact, it just turned up.
Okay.
Right. The trend for the Nasdaq also up and just turned up, even though these are rolling over right here. So it's something to watch. The trend for the Dow also up and continuing just to move higher. And then finally, the Russell 2000, which is the small and mid caps, which have been lagging the market. That one is also positive, but it's not out of the red yet.
Okay.
You see this red, even though this is green down here, it's still in this red zone.
Okay.
So small and mid caps are trying to make a comeback, but they're not quite there yet. Which then takes me to the last thing I want to show, which is the market bias view. Look how much green there is on here. I think when you left, there was a lot of red and yellows in this chart. And you can see the chart down here. So the orange one is the short term. The medium term is the gray. And look how the gray, usually the short term will move first, the medium term will move next, and then the long term. You can kind of see that here. Right?
Sure.
So the short term went up there, the medium term went up here. Now the short term is sort of rolling over, and the medium term has crossed it. And the long term is trying to catch up. So again, this might be pointing to a broader market. And one of the new things that I added is the top 20 gainers for the year. So this is year to date. And this was really enlightening. So if you look at year to date for the S&P 500 and Nasdaq, these basically two on the top are basically large caps. NVIDIA and Meta are the two big gainers. 220% for the year to date. Meta, 169%. But look at Royal Caribbean is up there too.
I saw that.
CrowdStrike, Palo Alto.
Pulte Homes. Yeah.
Pulte Homes year to date. It's in the top, top 6.
100. It's a double. Pulte Homes double.
Pulte is a double. That's right. Yeah. And then over here is the losers, which is enlightening as well. Look at the two at the top.
Yeah.
Two of the darlings back in the pandemic.
Yep.
In fact, right after
70%. Ouch.
Right. Down 70% for SolarEdge, and Enphase down almost 60% right there. Moderna also getting killed.
Dollar General. That's interesting.
Dollar General. One of the big losers for the year. Pfizer. Interestingly, Moderna and Pfizer, two of the pandemic vaccine makers.
People. Yep.
Right. So one of the bottom is the small and mid caps. What do they look like? So the big gainer is Abercrombie and Fitch. And this one over the last couple of months has just been right at the top of all the lists.
Interesting.
That one's up 230, almost 240% for the year. And then Supermicro, which is a AI play hardware company, up 228%. On the loser side, you've got SunPower, so another solar company. Yeah. Clearfield, telecom, entertainment,
Interesting.
telecom. So it's interesting. I will update this every week. This will change slightly, but it probably won't change a lot because it's year to date.
Right.
So some of these might just switch positions.
Sure.
You know, Salesforce might move down and Carnival might move up, something like that.
Yeah.
But in general, the year to date, since we're near the end of the year, these should look similar.
Yeah.
It'll be interesting when we start the new year and I do this as the year progresses. To see what the gainers and losers are. So in general, my thoughts on the market is that I think the market is going to continue higher. It's actually stronger than I thought it would be right now.
Okay.
It would actually be healthy for there to be a pullback.
Right.
There's an open gap down here, but gaps don't have to fill, or they can fill a year or 5 years later.
Okay.
There is an open gap, so it's something to keep an eye on. But that doesn't mean it's going to fill next week or next month. I think that we will continue into the end of the year. Now that the Santa Claus rally starts on the 22nd,
okay,
which is something a lot of people get wrong. They think the Santa Claus rally starts in the middle of December and goes till the end of the year, but it doesn't. It's the last 5 days of December, which is the 22nd this year, and the first 2 days of January. And I showed a chart of that in last week's newsletter for last year. And there's three components to it, and I'm going to start tracking this again now that we're in December, especially when we get to the 22nd. There's 3 components. If all 3 of them are positive, then the year almost always ends higher. Last year, it was the Santa Claus rally. It was positive by 0.8%, not by much, but it was. The first 5 days of January, which is goes back to Dow theory, and then the full month of January, which last year was up 6%. All 3 of those were positive, which means, you know, even in January, we should have predicted that the year was going to end positive, or at least expected that it would.
Right. Okay.
And by the way, the low at that point was 3,800. So I'm pretty confident it's going to end higher.
Yeah. Yeah. Very cool. Well, good. Let's get on to talking about economic indicators, but show you what, there you go. Show it again.
Absolutely. So breakpointtrading.net, just go there. If you want the free newsletter, just click on that. If you want to be notified when the newsletter is available, then sign up under the $0. This just registers your email, and you'll get a notification that the newsletter is ready. Or if you just want to come to the website and click on here, you can do it that way too.
Very good. Thank you so much.
You bet.